I spent 15 years inside a bank. I opened accounts for thousands of people, smiled, handed over the welcome packet, never told them the truth. Because the truth? The bank wasn't on their side. And most of those people are still losing money today, right now, and they have no idea why. These are the 5 savings accounts only dumb people open in 2026. Number 5, the Big Bank Basic Savings Account. You know this one. It's the account your parents probably told you to open. You walk into a branch, the banker smiles, slides a form across the desk, and 30 minutes later, you're the proud owner of a savings account paying you 0.01% annual percentage yield, 1/100th of 1%. On $10,000, that earns you, wait for it, $1 a year. $1. While the bank turns around and lends your money out at 6, 7, 8%. Here's what they don't tell you at that desk. Online savings accounts right now are paying between 3 and 4% annual percentage yield. Some are touching 5%. That same $10,000 sitting in a high-yield online account earns you $300 to $400 a year with the same FDIC protection, the same deposit insurance, the same legal safety net. Absolutely zero additional risk. I watched this play out thousands of times. Customers would come in, deposit their life savings, and just leave it there for years, decades, because they trusted the name on the door, and that trust cost them. On a $50,000 balance over 10 years, the difference between a big bank savings account and a competitive high-yield account isn't hundreds of dollars. It's thousands, sometimes tens of thousands. Big banks keep these accounts alive for one reason: inertia. Most people never move. They don't compare. They don't ask questions. And the bank counts on exactly that. And if you think that's bad, what comes next has an extra trap built right into the fine print. Number 4, the minimum balance penalty account. This one has a name that sounds perfectly reasonable. Standard savings, classic savings, sometimes even premier savings. But buried in the fee schedule, the document nobody reads, is a clause that turns this account into a slow money leak. Fall below the minimum balance, and you get charged a monthly FE. Doesn't sound like much. $3, $5, sometimes $10. But here's the math that should make you angry. If you have $1,000 in an account earning 0.10% annual percentage yield, you earn about $1 a year in interest. One monthly maintenance fee of $5 just cost you 5 years of interest income in a single month. I've seen fee schedules from smaller banks and credit unions charging maintenance fees the moment your average daily balance dips below $5. Others require you to maintain $2,500 just to avoid a $5 monthly fee. That's a $260 annualized fee on your own money. The accounts are designed this way deliberately. The bank knows that life happens, unexpected expenses, paycheck timing, a slow month. The minimum is set just high enough that regular people occasionally fall below it. And when they do, the bank gets paid instead of the customer. I've seen customers who were technically paying more in fees than they were earning in interest every single year, and they had no idea because nobody told them to read the schedule of fees and charges. Here's where it starts to get genuinely insulting, because the next account is sold as something that helps you. Number 3, the club account. Banks have been selling these for decades. The Holiday Club, the Christmas Club, the Kids Safari Savings Club. The pitch is simple: save for a goal. We will make it easy. And psychologically, it works. Forced savings with a purpose feels smart. The problem is the yield is embarrassing, and the restrictions are real. Most club accounts pay around 0.10% annual percentage yield. Some pay less. Your money is locked up, sometimes until a specific calendar date, and if you withdraw early, you can face penalties. On the kids' accounts, Some fee schedules actually state that if your balance falls below a minimum, a monthly FEE kicks in on a children's savings account. There is also something buried in certain account agreements I found genuinely shocking. Interest under $1 will not be paid upon account closure, meaning if you close the account before the interest rounds up to a full dollar, the bank keeps it. In 2026, locking money away for a year at 0.10%, when high-yield accounts are paying 30 to 40 times that rate, is not disciplined saving. It is just expensive. A $25,000 holiday fund sitting in a club account for 12 months earns $25. In a competitive savings account, that same money earns $800 to $1,000. Banks love these accounts because they are easy to sell emotionally. The interest cost is almost nothing, and the structure keeps savers away from asking about better options. Now we're into the top two, and this next one is sneaky because it actually sounds premium. Number 2, the relationship savings account. This one is beautifully designed. The bank offers you a preferred rate on your savings, but only if you link it to a checking account, meet a monthly transaction minimum, maintain a combined balance across multiple products, and maybe set up a direct deposit. You jump through every hoop. You feel like a valued customer. And your reward? Going from 0.01% annual percentage yield to maybe 0.03%. I am not exaggerating. Banks like Chase, Bank of America, and PNC are well documented for offering savings tiers that are only marginally better than the base rate, even for customers who meet every relationship requirement. You do everything right, and you're still earning a fraction of what an online bank pays someone who just signs up with an email address. The psychology here is sophisticated. The word preferred makes you feel like you've unlocked something. The bundle makes switching feel complicated. You've got your checking account here, your savings here, maybe a credit card. Moving one thing means disrupting everything. Banks know this. They build ecosystems specifically to make leaving feel hard. And while you're sitting in that ecosystem earning 0.02%, the bank is earning the spread between your deposit rate and whatever they're lending at. The only winner in a relationship savings account is the bank that sold you the relationship. And now we've reached number 1, the account that tricks the most financially aware people, because it looks smart on the surface. Number 1, the misused high-yield savings account. Wait, isn't a high-yield savings account supposed to be the good option? Yes. And no, the account itself isn't the problem. The way most people use it in 2026 is. Here is the reality. High-yield savings rates peaked above 5% in late 2024 and early 2025. Since then, the Federal Reserve has cut rates multiple times, and analysts expect further cuts through the rest of 2026. Right now, the best high-yield savings accounts are paying around 3.5% to 4% annual percentage yield, and inflation is running at approximately 3.2%. After taxes on that interest income, your real return, the actual purchasing power gain, is close to zero. Maybe slightly positive. Maybe not even that. This is what I call the silent trap. People move their money into high-yield savings feeling clever. They are earning 4%, not $1 a year like the big bank suckers, but they are parking long-term money, retirement contributions, 5-year goals, serious wealth in a variable rate account that the bank can cut with almost no notice. And when rates drop, those customers lose ground while believing they are still ahead. The smarter play in 2026 is understanding what each account is actually for. High-yield savings is a parking spot for your emergency fund and short-term cash, 3 to 6 months of expenses, money you need, accessible within weeks. That's it. For anything beyond 12 months, you should be looking at certificates of deposit or treasury bills to lock in a fixed rate before it drops further. For anything beyond 5 years, You should be investing, not saving. The stock market historically returns around 7 to 10% annually after inflation. A savings account, even a great one, will never beat that over time. The smartest, most financially aware people I know still make this mistake. They discover high-yield savings accounts, feel proud of themselves, and then slowly watch the rate decline while their long-term wealth sits idle. Don't be that person. 5 accounts. 5 ways banks profit from your inattention. Now you know. Don't go back. Like and subscribe for more.